Yeah, thank you also from my side. It's great to have all of this different contrast and perspective, which leads me to introducing Markus, my colleague at BWM. He's a financial analyst, has been with the firm for close to 20 years, doing analyst's work, and I think that's what he does best, and I'm very happy that he will talk about a couple of one company with two names.
Urban, thank you very much. I understand this is a tough spot here for me now. I'm standing between you and lunch, but still I hope that you have as much fun as I have diving into an investment case, so please bear with me just a few minutes. I'd like to give you an introduction into our analytical process, our investment process. And I will use the French car supplier Faurecia, soon to be renamed Faurecia, as an example. Perfect. We are looking for the instances where Mr. Market is acting irrational. For that, we cannot value every company out there, of course. So every investment process has to start with the idea finding process. An idea meaning a company where we have good reason to assume it might be undervalued. To come up with such an idea, there are plenty of different possibilities to do so, and I listed just a few. I would like to emphasize today the first two. Number one, whenever we do a valuation and then we come up to the conclusion that the company is not cheap enough, we put that valuation in our watch list. So if for whatever reason the shares decline thereafter, they show up automatically as a potentially undervalued idea. With that also, we keep record of all the insights and information we ever got from interactions with the management, with industry experts, which we use often. And that together is an invaluable asset to us as it gives us access to the breadth of 25 years of experience in our team. The second point is attending an industry conference. That's a very efficient way to meet and get acquainted with companies you might haven't followed in a while. And that is actually how I got to know Faurecia. I attended the IAA Automotive Fair in Frankfurt back in 2013 and had a management meeting at the time. And again in 2017, same thing. I was, number one, quite impressed by the management team itself, but also I was impressed by the way they were describing the business of Faurecia. There was a lot to like about Faurecia, and I will come to that in a minute. What we didn't like, and why we didn't continue the analytical work at the time, was the company was controlled by Peugeot. They had a 45% stake, I guess, at the time. But when Peugeot announced the merger with Fiat to become Stellantis, they had to give up their shares. And that was the point in time when we got all ears. Now, let's step back into that time early in 21. What did Faurecia look like? This is the breakdown of revenues by segments or product groups. The biggest chunk was 40% of revenues coming from the seating segment. They do full seats as well as mechanics and frames that you can see up here. The second largest segment was interiors, where they do door panels and instrument panels, the interior of a car. Then comes the clean mobility segment. There they do exhaust treatment systems like catalytic converters. And lastly, the smallest and youngest segment, electronics, where they do displays and cockpit electronics. The first thing we really liked to see was that in almost all of those businesses, Faurecia is the global market leader, the number one, highest market share. Second thing, especially in the automotive industry, is you might be concerned what's going on with the shift from combustion engine to electric vehicles. And already back in 21, it was good to see that 75% of revenues were powertrain agnostic. It was just the clean mobility, the catalytic converters, that are dependent on a combustion engine. And I'd like to remind you here that this business today is still growing, because globally in every market we have tighter and tighter getting emission control schemes. And also don't forget, all the hybrid powertrains still need a combustion engine. So this business for the next years to come is still growing. But the other segments are growing faster. And the other segments are outgrowing the overall automotive market simply because they are gaining revenue per share. They are gaining content per vehicle. Why is that? Looking first at the largest segment, seating. Seats are getting more and more complex over time. They are adding functionalities. heating, cooling, massages maybe, crash protection. They include audio systems going forward. All of that is increasing the content per car. They are also getting more versatile. When we're talking about autonomous driving, eventually seats will be able to turn around 180 degrees or offer a flat bed configuration. Another trend that is ongoing here is that all the functionalities that we are all used to in the front seat as a driver, most or many of those are also getting used in the rear seats in the future. All of that driving up the content per car. And the same trend actually is also visible on the interior side. While a door panel used to be a very simple plastic piece of thing, they will soon in the future be used also for cooling and heating the environment of the driver and the passengers. And they do so actually much more efficiently than using the air ventilation. And this is an important thing going forward when we talk about battery cars, because heat will no longer come for free, as we are used to. Those fundamental trends were also confirmed, not just anecdotally, but also in discussions we had with different industry experts through those networks, expert networks that we use. A few months after we bought the shares first time, Faurecia acquired the German lighting specialist Hella. This was a strategically very sensible move to do. The market loved it. The shares were up 12% on the day. I'll come to you in a minute what the problems were. But with the lighting business of Hella, where Hella again is one of the 3 largest players in the world and by far the number 1 with the German OEMs, that automatically increased the powertrain agnostic part of the business from 75 to 80%. And with the growth that we are expecting going forward, that will quickly go up to 90% already by 2025. So far, I talked about anecdotal evidence, things that were explained to me, things that we understood how the market works. But that was already visible in hard data back in 21. Here you see for the last 7 years, in blue, I guess, yes, the revenue development, and in green, the order intake rate. And in each and every year, the order intake rate is much higher than the actual sales numbers. So this shows you the company is on a sustainable growth path going forward. It's not just talking, it's hard numbers. The decline we are seeing in 20 and 21 on the revenue side, that of course is due to COVID and several related issues. There was just a lack of car production. And the uptick that we are seeing in 20, 6.5 billion of that is the acquisition of Hella, but also organically, revenue last year were up 17%. And on a side note, first quarter this year, revenues were up organically 18%, close to 18%. All of these are characteristics of businesses we would love to own if we can get it at the right price. So that's where valuation comes in. And valuation means number crunching. This is the most important tool that we are using. This is our financial model, and it's just a small snapshot of the whole thing. It's a standardized model for all our companies, looks the same, makes working very efficient, very easy, also for my colleagues to jump in and join the discussion. In that model, we have, of course, all the numbers released by the companies, but also all kind of metrics we calculate ourselves on the valuation side, on operating statistics, and the like. The first thing we always look at when we get to that model is what's the leverage, what's the balance sheet structure, how's the company financed. So let's look at this. Before we got into Faurecia, you see here the leverage ratio defined as net debt to EBITDA. The management has always been very, very prudent in managing their finances. Leverage has always been really, really low. When COVID hit and EBITDA went down, that's when the leverage ratio for the first time ticked up to 2.5 times, but also quickly reverted back to 1.5 times. That was for us perfectly fine. That's the time when we got invested. And as I mentioned, shortly thereafter, they acquired Hella. And with Hella, they improved the business mix. The whole business the product portfolio is getting better, has a higher quality today, but it also added higher share count, and it added a huge debt load. So the high debt level that we are seeing right now, that is, I guess, one of the main reasons why the shares are trading so cheaply today. And we take that very seriously. We look at this very, very closely. And it's not just looking at the simple leverage ratio like here. We also look at what kind of debt do they actually have. What's the maturity schedule? What are the covenants? And from our perspective, from our analysis, we are very, very confident that this situation is under control. For one, the company today has enough cash on hand to repay all maturities upcoming in the next 3 years. And secondly, they are deleveraging quickly. They have already signed deals for their disposal program of 1 billion euros. So we are confident that towards the end of the year, they will get back to around 2 times leverage and quickly go down thereafter to their own target of below 1.5 times in 2 years. That was the debt level. Let's talk about what's the profit chances of the company. On the profitability side, it's a good it's a good way to get started with company guidance. That is often too optimistic, but it's a good starting point. And here you see the company guidance, and the first point is the sales number, and their sales target for 25, that is easily achievable, and it's already confirmed that the orders they have. And don't forget, in the car industry, orders today are not sales tomorrow. Orders today are sales in 3 to 9 years for the model cycle of that car. So the important part for us was here to look at the operating margin. To model the operating margin, we do that on a segment-by-segment basis. And here I show you for the largest segment, for the seating segment, how we approach that. This picture shows you for every half year of the last 10 years, or 20 half years, on the horizontal axis, the sales level, and on the vertical axis, the operating profit, defined as EBIT. And the low point here, on the left corner, the only half year where they had a loss in that segment, that was the first COVID period. And all the periods thereafter were impacted by COVID, by the war, by inflation, by all things that are just not normal. If you just for a second bear with me and we blend those out and we focus on the 6-7 years prior to that. And here we can plot in a trend line, and that's the operating leverage, and it's a good fit for a long period of time. So you see here for 100 euros incremental revenue, the company is able to earn roughly 10 euros in incremental operating profit. And we see no reason why over the next 2 years the company should be able to get back on that trend line. The growth we have already seen on the order intake, and with that they would achieve actually their 7% margin target. Another concern many investors have is it's an automotive industry, it's a cyclical industry, so what about a recession? And for that, just take a look at the state of the current global automotive market. Here you see for the last 20 plus years, car production in all the 3 major markets, Europe, North America, and China. And when you look very closely, already 2019, all major markets were producing below trend. But then COVID hit. First with factory shutdowns, then with supply chain issues. So we have now 3 years consecutively in the past with recessionary level of production. And that is not because there's a lack of demand, but simply the OEMs were not able to produce those cars. That makes us very confident that even if we get into recession this year, car production this year will be higher than last year's. Come to an end, we have to look at the valuation. This is a chart showing you in blue the 1 year forward and in green the 2 year forward price earnings multiple for Faurecia over the last good 10 years. And this is based on consensus estimates at the time. I'm including the 2 year forward because when you look at consensus estimates, 2 years is a pretty good proxy for what the market believes is a normalized earnings power, a sustainable earnings power. And on first sight, you already see that the company is trading cheaply right now. But if we look at the 1 year forward and we look back to this period of normalized of a normalized environment, so 2014, 15, 16, 17, 18, in that time frame, you see the company typically was trading at around 11 times forward earnings. And we could discuss whether they deserve a higher one today because the product portfolio has been de-risked. But we take for our base case this 11 times the earnings estimate as our base case valuation and come up to a value of 51 versus right today they're trading at around 20, a little over 20 euros per share. You might say this is overly simplistic, and I would agree. But coming back to the model that I showed you earlier on, with that model, it's very easy to look at different kind of valuation metrics as well. We can do DCFs, we do sum of the parts, we do EV/EBITDAs, free cash flow yields, you name it. Point is, all of those give me different angles looking at the same thing, at the valuation, and those different angles have to show me the same number, at least the same range of number. If we don't, then that means we might have missed something. There is something wrong in the model. Also, using that model, it's very easy to play around with the assumptions. Rather than just the base case, I can say, listen, let's assume the company actually achieves fully their targets. That means operating margins above 7%. I can see what the fair value would be then. Or the other way around, I could say, listen, I just don't trust them and they will not be able to improve their margins at all. And I could see what the valuation would be then. And this is the summary chart that puts it all together, the whole story. The blue line is the share price performance of Faurecia. And the red columns show you when and how much we bought. And the thick green line, that is the base case assumption for the fair value. It's not a static number. It gets revised, of course, when new information comes along. And you see the valuation range that we put around that. In a summary, I hope I was able to show you not only how we think and how we work, giving you a little insight into our alchemy kitchen, but also I was able to show you that Faurecia is a good company with good businesses that are not impacted negatively by the shift in powertrain to electric vehicles, that is not impacted, or at least not lastly impacted by recessionary forces, if at all, I would add, this year. And also a company that has a debt issue, yes, but it's a debt issue that will very quickly be resolved. I mean, we believe it is resolved. We don't have an issue, but it will also be resolved on plain sight if you just go 6 months ahead. And this is a business that we really like, and it's a business we like to own. It has the right price, and it's trading at a significant discount to our fair value and its historic valuation. With that, I am open for any comments or questions you might have, or for lunch, and I'll be there as well if you want to have a discussion.
So I think we'll do again one question right there. Thank you.
Thank you. I think it looks like an interesting company, but I would like to know about the peer group situation. Why does an OEM says I will choose a product from Faurecia or not from another company? What is the competitive advantage of the Faurecia product?
Yeah. A lot of the things are actually patented, so you got a patent protection. And the other thing is the main barrier to entry, I guess, there is the client relationship. You don't want to mess around with those. When you get into a car, you are locked in for that model. And you typically get the follow-on contract when the model gets renewed thereafter. And right now, actually, Faurecia is declining orders. They get orders, or they get requests for proposals that they are not answering because of the high order intake rate they have, which also gives some confidence that they should be able to reach their margin target.
Thank you very much, Markus. Thank you all for being here today. I hope it was a value. Thank you.